Hello, and thank you for joining me for the Wealth Building Strategies Top 10 Multifamily Investing Benefits. You'll notice in the lower right-hand corner of the slide, there's a QR code that'll give you access to our investor portal to become part of our professional investing network. You also have our website, investwithdmi.com. And you can go in there and request access if you're interested in reviewing investment opportunities that DMI offers. My name is Eric Mattingly. Just a quick background on me before we start. I'm the president and founder of DMI Holdings. I've been a professional investor for a little over 20 years, and I'm a nationally recognized public speaker and investment educator, and we created a workshop series to help educate our investors called the Wealth Building Strategies, with this being one of them. I've been involved in structuring a little over 100 private placement syndications, totaling a little over $1.5 billion, and have invested in 34 large multifamily properties, totaling approximately 7,000 units as both a passive and active investor. My expertise is in private capital and forming strategic partnerships. And I was also inducted into the USA Martial Arts Hall of Fame for Mixed Martial Arts Master of the Year. So what we'll be covering today is the top 10 benefits of investing in multifamily, which include group purchasing, the ability to leverage, operational efficiency, forced appreciation, return of capital, passive income, tax advantages, above market returns, hedging against inflation, as well as being able to invest with self-directed IRAs and other qualified plans. So group purchasing, investing in multifamily is very capital intensive. Unlike single family, you generally need quite a bit of capital. So group purchasing allows investors to combine capital with other investors to purchase a larger and potentially more profitable real estate investment. The lead investor or investors, also known as the sponsor group, identify the property, conduct due diligence and underwriting, secure property management, organize investment capital, and are required to guarantee the loans for the financing on the property. The sponsors on the project are the general partners and are responsible for overseeing the operations of the property and providing reports to the limited partners. The passive investors are the limited partners, the LPs, that purchase a fractional ownership on the property and have no debt liability or management responsibility, as well as any operational duties. Multifamily will allow you to leverage your return through the use of strategic debt financing. So investing in multifamily allows investors to use debt more strategically than with single family real estate investing. In most cases, when buying an existing multifamily property, the financing is non-recourse and does not show up as a liability on a financial statement to the loan guarantor or guarantors. The general partner or the sponsors acts as the guarantor on any bank financing for the property. So the limited partners are not signing on any loans and have no debt liability or responsibility. The passive investors get the benefit from the leveraged financing and getting a leveraged return without having to guarantee any loans. So the return on investment to the investors are significantly greater as a result of the leverage being used. There are also tremendous operational efficiencies when investing in multifamily and provides economies of scale at affordable costs compared to single family investing. In this case, the property is professionally managed with on-site property manager, leasing staff, and maintenance. The general partner acts as the asset manager and works with the third-party property management company who in turn oversees the property level management staff. The best economies of scale and value are on properties with 100 units or greater. It's not to say that investing in a 75 unit property is bad, but just to give you an example, if you had a 50 unit property, you're still going to need a property manager, a leasing agent, and a maintenance staff member. And it costs the same whether it's a 50 unit property, a 100 unit property, or a 150 unit property. That's what we mean by economies of scale. One of the unique features that multifamily investing has is what's called forced appreciation. This is one of the primary reasons I personally invest heavily in multifamily, and our investor network invests in multifamily. So the value of a multifamily property can be increased by reducing operating expenses and increasing income. Below are a few examples. I'm going to show you only 4. However, there are 10 or 15 strategies that either reduce expenses or increase revenue, which therefore translate into increased value of the property. This is on an actual project that we currently have. For example, by reducing the water bill by $25,000 a year at a 5% cap rate, the value of the property would increase by $500,000. One of the first things we do if we take on a new acquisition is install a water conservation and energy conservation program that immediately reduces expenses and simultaneously immediately increases the value. Charge an extra $10 a month on 50 covered parking slots. That's $500 a month, $6,000 a year. And if you put a cap rate to that at 5%, just as an example, the value of the property then would be increased by $120,000 by just adding $10 a month to a few covered parking slots. By increasing rent $100 a month per unit on a 100-unit property, that's $120,000 a year of additional income. At a 5% cap rate, the property value would increase by $2.4 million. Increasing rents and charging premium rental rates on upgraded units is one of the main ways that you're able to quickly boost values within the first 2 to 3 years of taking over a property. On a value add acquisition, you're looking for properties that are charging rents that are below what the sub-market is actually getting. So when you're going in there, you're not just trying to push your rents up, you're simply trying to bring your rents up to current market value, which is very different than just banking on standard 3 to 6% annual rental rate increases, which also obviously helps. In addition to bringing your rents up to market value, you also are going to have upgraded and premium units with additional amenities where you can charge a greater monthly rental rate. And in this case, if you upgraded 50 units on a 100-unit property and you're able to charge an additional $150 per month by adding, say, a washer and dryer that wasn't already there, that's an additional $90,000 a year in revenue. And if you run a 5% cap rate on that additional income, the value would be increased by $1.8 million. By doing only these 4 things, the property would increase in value. Looking at a few different cap rates, just as an example, at a 6% cap rate, you would have increased the value of that property by $4 million. At a 5 cap, it's $4.8 million, and at a 4 cap, it'd be $6 million. Generally, once you've executed on these value add strategies within the first 18 to 24 months is when you would go and seek a refinance or a supplemental loan to be able to pull capital out of the investment back to the investors. On the right, I just put a note, if you're not familiar with cap rates, it gets a little confusing, but you don't need to overthink it. But a capitalization rate, which is also known as a cap rate, is calculated by dividing the property's net operating income, NOI, from its property asset value. So for example, if you had $500,000 in net operating income and you had a $10 million property, that's a 5% cap rate. Another simple explanation is assuming you purchased the property all cash based on the net operating income, what cash on cash return does that property generate? So a $10 million property generating $500,000 in net operating income is a 5% cap rate. Another unique feature that you can't do on many investments is to be able to have return of capital events, but still own the investment. So to give you an example, once you've reduced expenses and you've increased your income, as we discussed in the previous slide, typically within 2 to 3 years, the property will either be refinanced or you would obtain a supplemental loan to return somewhere between 25% to 75% of the investor's capital without reducing the investor's ownership percentage. If we couldn't return at least 25% of the investor's equity back to the investors, we probably would wait until we got the income up higher before we would actually execute on a refinance or supplemental loan. In some cases, within that same period of time, I've invested in properties this has happened on personally. You can potentially get back 100% of your original investment capital, still own the investment, still continue to get income, still receive tax advantages, as well as your proportionate pro rata share of the capital gain on sale. This process continues generally every 2 to 3 years. The goal is within 4 to 6 years, investors have received back 100% of their original investment capital if the property has not been sold by them. And this would be done by either refinance or supplemental loan distributions. If the property is held long-term, additional capital events through loan proceed distributions can continue to occur roughly every 2 to 3 years if the collective partnership elects to continue to pull money out. And the nice thing is, if the property is sold, instead of held long-term, investors would receive a return of capital if they hadn't gotten all their money back from the refinance first, and then they would receive a capital gain from the profit distribution on sale. The next thing is cash flow. A lot of investors do what's called transactional investing, where they're fixing and flipping a home, or you're buying and selling stocks. Multifamily investing can produce ongoing passive income even after investors have received back 100% of their original investment capital. Income from multifamily is, from a tax standpoint, taxed as passive rental income. Passive income distributions generally begin within 3 to 9 months on an acquisition, and generally 18 to 24 months on a ground up construction project. Year one cash flow is generally lower than subsequent years, especially on an acquisition, because you're inheriting the cash flow that's there, and then you're spending 18 to 24 months reducing expenses and increasing income, as we've discussed on the previous slides, to get your net operating income up, which also simultaneously increases your cash flow. Once you've gone through a refinance, you've gotten a big chunk of your money returned to you. Generally, that's going to significantly increase your cash on cash return, because you would have less money invested to be paying a return on. So by reducing expenses, increasing rents, and additional income, cash flow can increase each year. There's also significant tax advantages available by investing in multifamily. So investors can substantially reduce their tax liability via cost segregation and bonus depreciation, which speeds up the rate at which investors can claim tax deductions. Income is taxed as passive rental income. In addition to that, there are annual depreciation deductions that are passed through to the limited partners. And then sale proceeds are long-term capital gains if held longer than 365 days. Unlike a single family home, you don't see a standard fix and flip that might take 6 to 8 months with a multifamily property. It doesn't mean you don't necessarily sell a multifamily property in a short period of time, but that's generally, longer than 12 months. Loan proceed distributions are not taxable at the time received, even after investors have received back 100% of their investment capital. This is a huge benefit. So if you hold a multifamily property long-term and you would otherwise sell it so that you could receive a capital event, you don't necessarily have to do that. You could actually go in, as long as you've got your income, your net operating income up, you can go in and pull additional monies out and have a capital event, but without a tax liability from refinancing or doing a supplemental loan. So this is a huge advantage to investors because you can have sale event type experiences without actually selling the property and still maintain all the benefits that the property is producing. And then at the end of the year, investors are going to receive a Schedule K-1. That's all you're going to need to provide your CPA to file your taxes and be able to take your share of the tax advantages. Investing in multifamily can also provide above market returns to investors through a combination of cash flow, capital events, capital gains, as well as the tax advantages. What is an above market return? That is really a personal choice. For us, we look at above market returns as anything 10% or greater. If an above market return for you is 50% per year on your money, well then, you might not achieve your goal on a multifamily property, but that's the way we look at it. In general, multifamily can produce cash flow between 4 to 10% per year passive income. Investors can have a return of capital event when the property is refinanced or supplemental loan, which can return part, and in some cases, all of the invested equity, leaving a low to zero basis, but still own the investment. By simply reducing expenses and increasing income, even slightly, values can increase significantly to realize a strong capital gain on sale. Between cash flow and gain on sale, investors on average can consistently achieve double-digit returns, which is what we consider above market. And then as a result, multifamily is one of the most predictable ways for investors to earn above market returns. Investing in multifamily is also considered a hedge against inflation, since values increase as expenses on the property are reduced and rental rates are increased. If you just look at this last year, I believe the inflation rate was 8 or 9%. So that means that you have to be earning consistently 8 or 9% on your money to simply be able to buy the same things you were the previous year. So you've got to have investments that are predictable and be able to give you above market returns. Single family investing has what's called natural appreciation and depreciation based on the buying and selling activity in a particular submarket. Multifamily has forced appreciation, which we covered in a previous slide, regardless of the submarket. Value on a multifamily property is dictated by the net operating income, as we discussed previously. By simply reducing expenses and increasing income even slightly, the values can increase significantly. And as a result, multifamily is also considered one of the most predictable and stable investments available to investors to hedge against inflation. And the last benefit is you can also invest with a retirement plan. So investing in multifamily can also be done inside any type of qualified plan that's structured as a self-directed IRA or other type of plan. So that includes traditional IRAs, Roth IRAs, traditional 401ks, 401k Roth, Keogh plans, SEP, HSA, etc. pretty much all qualified plans can be self-directed. And once you've done that, gives you the ability to be able to invest in things outside of stocks, bonds, mutual funds, EFTs, and such. And just gives you more options with investments that can consistently give you above market returns. Just real quick, we're going to go through just a couple of case studies to give you an idea of the type of properties that we invest in. And again, the QR code you see here, you can scan that with your camera and it'll take you over to a request access to our investor portal. And you would just fill out the information and gain access to review opportunities like you're about to see here. So we kind of invest in two categories. One of them is value add acquisitions, meaning we're buying an existing property that's there. We're going in and fixing problems, bringing rents up to market rates, and improving the value. So this one here is called Clearbrook Village. I'm not going to go over these in extensive detail, but just touch on a couple of high points here. So this one is in Memphis, Tennessee. It's 144 units. The purchase price was $3.3 million, acquired in September 2018 and sold August 2021. And the value on the property was increased by $5.8 million in a 3-year period of time. Based on the way the investment was structured for the investors, they more than doubled their money in a 3-year period of time. So in this case, instead of holding the property long-term, there was significant appreciated value. A lot of value was able to be added. And in some cases, you don't refinance and you just sell the property. That's what happened here. Next one, in 4 years, investors doubled their money. This was in Gainesville, 157 units, bought the property for $10.4 million. Value was increased by $7.3 million and some change, and sold for $17.8 million. Again, great returns above market. And in a 4-year period of time, investors doubled their money. That's an average of 25% per year. An average multifamily property should hit you somewhere between a 15 to 20% annualized rate of return. That's what we look for in making a decision if we want to move forward on a multifamily project. And then the last one here is 151 units, Dalton, Georgia. This one had a lot of renovation. 20 units were rebuilt basically, but then those units were able to be rented for significantly greater value, which translated to increased net operating income. And then the property was sold for $23 million. And basically in 3 years, investors doubled their money. So that was pretty significant. The other way we invest is in ground up development. And in this case, the value is added through the development versus buying an existing property that's there. This one's called Cypress Creek, was sold in June 2021. This was an actual 6-year hold. So construction was completed in 2016. I basically worked the program. There was a refinance event. But at the end of the day, the investors over a 6-year period of time generated 140% return on their original invested equity. So a $100,000 investment, 6 years later, they had gotten their principal back plus an additional $140,000. The next one is in Paris, Texas. This one is a 3-year hold, 72% in 3 years, not bad. Once this one got fully occupied, it was then sold. So again, instead of holding it long-term, you can also sell, realize your capital gains, and go invest elsewhere. And then the last one here is in Palestine, Texas, 136 units, acquired in 2020. This one was sold instead of refinanced, and investors generated a 14% return. So in approximately 3 years, it was a 42% return on invested equity. Again, above market returns. And with that, we're going to conclude. I appreciate you joining us. We have a lot of other workshops that we will share with you. And again, if you want to have access to be able to invest in properties like this, you can scan the QR code there. You can also email us at invest@dmi-mgt.com, as well as go to our website, investwithdmi.com. So again, thank you for joining me and look forward to talking to you soon.